Good morning. Welcome to Trading Hour. It's a holiday-themed Monday morning. You're watching Trading Hour. I am Reema Tendulkar. With me is Vivek Iyer. As we speak, the Nifty is almost at the 23,800 mark, staring at a minor cut of about 15 points. Sensex has been moving between the red and the green line, but there is green on the screen for the mid-cap index. The mid-cap index is up 0.25%, though the advance decline ratio still is in favor of the losing side. We've got about 2 stocks advancing, with 3 in the red. But as an intraday graph of the morning will tell you, we've largely managed to recover from the day's low. The Nifty's moved in about a 120-point band. At the day's high, the Nifty was at 23,844, which is still below the 200-day moving average. So even as we've made a recovery from the lows, the key will be if the markets can cross that 200-day moving average. But again, it's a holiday-thin trade. Hi.
Absolutely right. Good morning, Reema. It's a very thin trading session, like you mentioned. Volumes are low because most of the large funds are actually not really being quite active in the session, and not too much news flow as well. Like you mentioned, it's the broader end of the markets that are faring relatively better. A couple of stocks that we are looking at. First up has to be JSW Energy. A significant news development coming in over there. The company has acquired renewable energy platform O2, and brokerages have given a thumbs up. It's a good valuation as far as this particular deal is concerned. The stock higher by almost 4% in the intraday session. A lot of listings today. Even last week we had a day we had 4 listings. Today we had 3 listings. So Senores Pharma, Ventive Hospitality, those are the ones that are actually doing quite well with strong listing gains. But on the other hand, Carrara, the management, we just had them on the previous show. That's been a muted listing, down almost 7.5%. And from the broad end of the markets in the pharma pack, Biocon is one stock that's doing quite well. The company sales milestones as far as the Viatris acquisition has been fulfilled, and the street likes that particular development.
All right, let's get to the IPO action, which remains hot even towards the year end. We've had 3 listings today. Senores Pharma, which has been the blockbuster one, Carraro India, Ventive Hospitality. So just to give us a preview of what these companies do, we've got with us Vamakshi with the details. Vamakshi.
Well, good morning, Reema. Senores Pharma is the first one that I'll be talking about. They had a stellar listing because they listed at 600 rupees per share, which is coming in at a 53% premium to their issue price. The company is a global research-driven pharma company. They focus on cardiovascular, diabetes, gastroenterology, and critical care injectables. The company manufactures products at its FDA-approved facilities, and they have a very significant presence in the markets like US, UK, as well as Canada. In addition to that, they also offer contract manufacturing services and is also vertically integrated by producing its own API. In addition to that, they're also expanding their presence in emerging markets. They're increasing their R&D capabilities, and they plan to drive growth ahead through acquisition and expansion of their manufacturing facilities. But when you look at the company's valuations, it seems like it is trading at a premium to peers like Ajanta Pharma, Gland Pharma at the issue price of 600 rupees per share. The price to earnings ratio stood at 58 times, which is much higher as compared to some of its peers. Ventive Hospitality is the other stock that listed today. The company listed at 716 rupees per share, which is coming in at an 11% premium. Keep in mind that this is the company is a hospitality asset owner with Marriott, Hilton, Minor and Atmosphere hotel brands. They have a portfolio which comprises of 11 operational hospitality assets, both in India and Maldives. They have total keys of somewhere around 2036 across luxury, upscale and upscale segments, and the plan is to increase it to 2,403 by FY28. In addition to that, they also have 3.4 MSF of commercial space that yields rent with 95.55% occupancy. Lastly, let's also focus in on Carraro India. They listed at 651 rupees per share, which is coming in at a discount to its issue of nearly 8% to its issue price. The company specializes in manufacturing of components ranging from small gears to complete tractor assemblies. They have 2 manufacturing plants in Pune. Some of its key customers include Mahindra, Action Construction Equipment, Volvo, among several others. But a weakness that that the company has a high dependence on very few customers. From top 10 customers accounting nearly 85% of its revenue. And the company very recently joined us, just a short while ago, and they say that they saw some slowdown due to elections, but they're not anticipating a very big recovery in the second half.
Thank you so much for that, Vamakshi, giving us an overview as far as all three listings are concerned. Like you mentioned, we had the management of Carraro in the previous show. Right now, we will be speaking to the management of Senores Pharmaceuticals. It's all strong debut on D Street, listing at over 50% premium at 600 rupees a share versus an issue price of just 391 rupees a share. To discuss more on the company once it has been listed and the way forward, we are now joined by Swapnil Shah, the Managing Director of Senores Pharmaceuticals. Thank you so much for joining us, Mr. Shah. Congratulations on such a strong listing. You now are a lot more answerable to shareholders now that you're listed on the exchanges. As far as FY25 is concerned, give us a sense of where you will end the year in terms of top line, EBITDA margins, as well as profitability.
Yeah, thank you. Thank you for having me, and thank you for just briefing me about everything. So, for FY25, we would continue our growth trajectory that we have shown in the past, and both on the top line revenue side as well as on EBITDA side. So it will be better than the industry averages, as I've been talking about, and you will see in coming days in terms of what kind of growth that companies is endeavored to companies going to achieve.
Swapnil, to your mind, what would be the industry growth rate that we should expect for the next 2 to 3 years? And also on your margins, because from the RHP, the numbers that we have, the margins range from 17% all the way to 46% that you enjoyed in FY23. What's the sustainable margin range?
Yes, so the growth likely would be coming from our CDMO, CMO space in the US as we speak. We've signed multiple deals with large pharmaceutical companies, which will give us a massive tailwind on the CDMO, CMO side of the business. As well as we have about 51 products that are in the pipeline. Some of them are already filed, some of them are going to be filed, and so on and so forth. These are niche opportunities. They are large CGT portfolio that we have will further continue to grow. Can't speak for other pharmaceutical companies, but I feel with the growth drivers that we have both on the regulated market as well as emerging market. Emerging market, we have about 600 odd products that are under registration that will likely to get MOH approval and then commercialize in next 12 to 18 months. So those two aspects of the business that we see will continue to drive significant growth. Coming to margins, the first half of margin that you saw for us, that will largely be continue, and we expect as we utilize our capacities more and more approvals will come in both on the CDMO, CMO as well as our own product. Our margin would expand from what it is today. Optimum margin would be a little difficult to say at this point of time. Maybe post March numbers, post full year, we can give some guidance on that side. But I strongly believe and see margins likely to improve and will continue to have the similar growth trajectory as we move forward.
Swapnil, two things that the street wants to know and that they're quite excited by as far as the opportunity for you is concerned, especially in the developed markets. Number one is CGT, which is the competitive generic therapy, and also the opportunity as far as the portfolio is concerned in the 505B. First up, give us a sense of how does your portfolio look like in these particular areas? What is the opportunity size? And give us a sense, if you could quantify in terms of opportunity, what is it that you can expect to make once your products go on street?
Correct. So, a lot of those products we have 505B2 opportunities that we are currently undertaking it. We have NDA opportunity that we are currently working on, which is going to significantly aid our revenue as well as our profitability. There are unique products that we are launching first time in the US. May not be the NDA or a NDA or a NC, but those are newly launched strains of existing approved generic products. So a lot of those uniqueness that we are doing, which I feel or I see a lot of our competitors are not currently doing it, or they're still far away from launching those kind of products. So you will see in next few quarters, multiple of such launches will happen with a unique proposition that we can offer to the market.
But just getting back to that point about, the 4 CGT, the competitive generic therapeutic designations, CGT, where you have 6 months exclusivity in the US. What could be the potential revenue coming out of that?
Difficult to say right now, exact number, but large part of our revenue would be coming out of those CGT opportunities. Just to give you a perspective, 51 pipeline products that I just said, 28 of them are CGT opportunities for us. They stand as CGT opportunities today. Not necessarily will be getting all 28 approvals when the product gets launched, but large part of those 28 may be qualified as a CGT opportunity, which in turn will get about 180 days of exclusivity, which has happened with us in the past in our current approved products. So that will largely continue as we move forward.
Swapnil, out of the 500 crore fresh issue, you've earmarked close to 200 crore for M&A activity. Give us a sense of the targeted entity. Is it one large entity, or are you looking at multiple tuck-in acquisitions? Anything that you have zeroed in on? And what kind of capabilities will the acquired entity have that you will be interested in? And also valuations if the deal is in the advanced stage.
So currently, we are not looking to acquire any entity as we speak. Currently, we are looking to acquire a product level acquisition. So we are looking at multiple product level acquisitions in the US and outside US as well to add to our current offering in the market. Again, our idea is not to acquire those products and launch a generic version of it. We'll again create some uniqueness around it, launch a novel strength or a combination of a product and then launch it in the market. So again, I'm saying, we don't want to do what everybody is doing. We want to create our own space, which we already done. We'll continue to expand and grow and provide the uniqueness. We are not here to compete with people. We are here to create something where we can establish ourselves in.
Swapnil, lastly, what is the plan as far as the US manufacturing facility is concerned? What is the stage of development there?
So I assume you're saying about injectable or
That's
oral
right.
solid is already
That's right.
there, right? So on injectable side, on injectable side, as we speak, we will start the construction. I think in next few months we'll firm up our plans in terms of establishment. Product development is already started, so there are a lot of products we are currently working on the injectable space that we want to do it in the US market. So as the product development will happen, we also want to acquire few products on the injectable space as well. So as we move forward, they'll be established and then we can start manufacturing. Again, on the injectable, our business contours will remain same. We'll continue to do niche products for us, for ourselves, where the ANDA is with us, IP is with us, and then we'll expand on the CDMO, CMO side, also on the injectable. So we'll add our capability with injectable along with oral solids. We'll have the injectable both on the CDMO, CMO side as well.
Thank you so much, Swapnil, for joining us. Congratulations once more on such a strong listing, and we wish you and your team a very happy 2025. Well, let's now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Welcome back. It's time now to shift gears and talk about commodities. Manisha is now joining in, and she's talking about iron ore, which has had a very tough 2024, Manisha.
Oh, well, yes, last day of 2024, and we've seen big moves come in for a couple of these commodities like a natural gas, which is surged up, but an iron ore prices have continued to decline. So when you look at the prices right now, they're trading at a 5-week lows. We have seen prices fall below $100 a ton as well. And for the year, it has been a 29% of a decline for prices here. Well, the reasons are plenty. One, the dollar index trading at a 2-year highs has led most metal prices declining. The second is that when you look at the ferrous metals, it has been about the weak China data. The weak industrial profit numbers for a 4th straight day coming in from China have been weighing. So has been the fact that this China's construction sector still continues to be sluggish there. The markets also are looking at very high supplies when it comes to iron ore from major producers like Australia and Brazil as well. Going forward, it really is going to be about the month of January, and what Trump does in sense of tariffs is what the markets will react to. But the second thing also is that China already has talked about 3 trillion yuan of injection in 2025. That seems to be supporting prices right now. But most banks and brokerages believe that 100 or perhaps thereabout or below is where the iron ore prices could average in 2025. For 2024, we did see prices go all the way high to $144 a ton as well. But that is a price not many believe you will see in 2025.
Thank you very much for that. And now it's time to once again rewind 2024. And we're putting the spotlight on the India's automobile industry. Now, it's more than tripled in size if you compare it to the last decade. But as the industry aims to get on par with global peers, the shift towards cleaner fuels is necessary to maintain sustainability. So Sudarshan is now joining in, and he's putting the focus on the industry's bid to move away from fossil fuels.
In 1983, India's automobile revolution was ignited with the launch of Maruti 800. Affordable, reliable, and aspirational. It became the people's car. And since then, India's automobile industry grew exponentially. Today, India is the 3rd largest automobile market globally. In last 10 years, the industry has tripled in value, from rupees 7 lakh crore in 2014 to rupees 22 lakh crore in 2024. But even with this growth, we are only half the size of China and a quarter of the US market. The goal, to surpass both within the next decade.
Now in world, USA is number 1. They have the size of auto industry of 78 lakh crores. China is 47 lakh crore and India is 22 lakh crore. Now we have a target that within 10 years, we will be number 1 in the world because of alternative fuel and biofuel.
And how will we do it? The answer lies in a new kind of fuels. The shift will be driven by 3 key factors. First, emission targets. India aims to cut carbon emissions intensity by 45% by 2030. Second, reducing fuel imports. Did you know that India imports 90% of its crude oil, spending $71 billion annually? Third is cost savings. Clean fuel vehicles are cheaper to operate. For instance, running a CNG vehicle costs just rupees 1 per kilometer compared to rupees 2.25 for petrol. So what are those alternative fuels that will drive the future? First up, electric vehicles or EVs. India's EV market is set to grow from $23 billion in 2024 to $118 billion by 2032. The government's target, 80 million electric vehicles on Indian roads by 2030. But EVs aren't the only players in the game. Hybrids are bridging the gap. These vehicles combine electric power for short trips and fuel for longer journeys. They are cost-efficient, eco-friendly, and ideal for a gradual transition to clean energy. Next up is ethanol. India is aggressively pushing for ethanol-blended petrol, targeting 20% blending by 2025. Brazil serves as a global example, using ethanol to replace up to 20% of its petrol imports, with 80% of its cars running on ethanol-blended fuel. Brazil has significantly cut its oil dependence. India could follow a similar path. We also have CNG and LNG. They are cleaner and more affordable alternatives to petrol and diesel, and their adoption is growing rapidly. Sales of CNG passenger vehicles surged by more than 30% year-on-year in the first half of FY25, and the market is expected to grow at a CAGR of almost 7% in next 6 years. Last is hydrogen, the fuel of the future. Clean, versatile, and sustainable. It's a game changer for heavy vehicles like trucks and buses.
Hydrogen is the future. And the green hydrogen is the future. Because by electrolyzer process making hydrogen, for 1 kg of hydrogen we need 150 unit of power. Now the municipal waste are by using biotechnology generating biomass using for getting it methane in biodigester, and from that methane we can convert into hydrogen or we can convert into CNG.
2025 is not just another year. It's the year when clean fuels take the driver's seat in India's automobile story. Over 40 new car models are expected to hit the Indian roads in 2025. And guess what? Only 20% of them will run on petrol or diesel, and that too with most of them having the hybrid option. The future of mobility is here, and it's cleaner than ever. Electric vehicles, or EVs, are set to dominate 2025. From Maruti to Tata, Mahindra to Mercedes, every major automaker is going all in on EVs. The goal? To accelerate towards 30% EV adoption by 2030. And that is up from just 6% today. But EVs aren't driving the change alone. Ethanol-powered vehicles are making headlines. As per Roads Minister Nitin Gadkari, big names like Tata, Mahindra and Hyundai are set to launch 100% ethanol-powered cars within the next 6 months. Meanwhile, CNG is steadily solidifying its place as a preferred fuel option in India's green mobility shift. In 2025, Honda is set to join Maruti, Tata and Hyundai in offering CNG-powered models. Tata will introduce the Curvv in a CNG variant, while Maruti plans to launch next-generation CNG versions of its popular Ertiga and Brezza. Adding to the momentum, Honda is expected to unveil a CNG variant of its Amaze sedan. The future of India's roads is not just about speed, it's about sustainability. It's the year clean fuels go mainstream.
Thank you so much for that, Sudarshan. Well, let's now slip into a short break. When we return, we will discuss market technicals with Soni Patnaik of JM Financial Services and also discuss her top trading bets. Welcome back to Trading Hour. As promised, Soni Patnaik from JM Financial Services joins us for a quick technical check of the market. Good morning, Soni. First up, give us a sense of where do you think the Nifty and the Bank Nifty is headed? Are we once again hitting resistance levels?
Hi, good morning, Vivek and Rima. Thank you for having me on your show. Sir, I think what we can see for Nifty in Jan series is that the rollovers for the Jan series has been in line with its average. This could be, when we've seen the support around 23,600 not breaking, rather it is defending the support. There's a possibility that Nifty is heading towards 24,000, 24,100. Now that is acting as a crucial resistance for Jan series. If it's able to cross that resistance level, we can see it even further higher towards 24,500 for the series. But as of now, as long as 23,600 gets defended as a strong support, in next 2 to 3 days, we can see Nifty heading towards the 24,000, 24,100 resistance. And from current levels, Nifty remains a good buy on small declines up to 23,600, which is acting as a support. We'll have to see further from how it goes beyond 24,100. Similarly, if we talk about Bank Nifty is also holding on to its levels of 51,000. I think that's very crucial for Bank Nifty to continue closing above 51,000 mark. If it's able to cross 52,200, Bank Nifty can head towards 53,000 mark. I think both the indices are consolidating sideways. But as the data is building up, we can see them heading towards the resistance. It's only a matter of time it breaks above the resistance to see further upside.
Okay, it's picking up now for the Nifty Bank after being flattish or just up marginally. Now it's up a good 300 points. Innocent Bank is up over 1%. Axis Bank, Kotak Mahindra Bank, higher in trade. HDFC Bank has recovered nearly 1% from the day's low. Soni, what would your top picks be now for the day?
So Rima, the first buy pick for the day would be in Hind Petro. Now, Hind Petro has been supporting 400 base. I think that's looking quite strong. There's enough put writers defending that level. So one can buy Hind Petro for an intraday basis, keeping a stop loss of 400 and a target of 420 to 425 can be seen. So it's mostly an intraday short-term trade. The second buy would be in IEX. Now, IEX has been defending its 200 exponential moving average quite strongly around 178, 176 range. It is also crossing its 20 and 50 exponential moving averages today. So one can buy IEX, keeping a stop loss of 176 and a positional target of 195 plus can be seen.
Thank you so much for that, Tony, and for giving us both your index levels as well as the top picks. Well, as we now slip into a short break, here's some good news for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store. Welcome back to Trading Hour. Well, there's been a bit of a recovery and there's a bit of a rally as far as financials as well as NBFCs are concerned. Some of the names like IndusInd Bank, Shriram Finance, Manappuram Finance, these are some of the stocks that are trading at the day's highest points. Manappuram, in fact, up almost 5% in the session. But moving on, HDFC Bank and Siemens India are in focus on the back of Chris Wood's latest greed and fear note. Hormaz joins in with more details.
Yes, Chris Wood indeed has turned positive on HDFC Bank, and he has reintroduced his investment in India's largest private lender in his Asia ex-Japan long-only portfolio. And HDFC Bank will carry a 4% weightage in that portfolio, and that will be accommodated by trimming his investments in 4 names: Macrotech, L&T, ICICI Bank and Axis Bank by 1 percentage point each. Now, within the India long-only portfolio, HDFC Bank is already a part of that, so its weightage in that will go up by 1 percentage point, and that will be done by trimming the investment down in Axis Bank. So HDFC Bank is back on Chris Wood's radar, but what is also on the radar is Siemens, and that was on the news all through last week, considering the fall that it had seen, almost a 15% drop in the week gone by. And Chris Wood has introduced Siemens as an investment both in the Asia ex-Japan long-only portfolio and the India long-only portfolio. Both of those places will have a 4% weightage each for Siemens India. Now, in the Asia portfolio, this will be done by trimming investments in the preferential shares of Samsung Electronics and in SK Hynix. And for the India portfolio, that will be done by completely excluding the investment in AU Small Finance Bank. So Siemens, Chris Wood buying the dip, and HDFC Bank is where his radar is back on.
Okay, and looks like it's working, because HDFC Bank is recovering from the day's low and is now back in the green with a gain of close to about extending itself 0.4% up now in HDFC Bank. Well, let's talk about IT, because today we've got 2 conflicting notes on IT. You've got Goldman Sachs on one hand, which is constructive on the tech sector going into calendar year 2025. But on the other hand, you have Investec, who believe the risk reward is currently unfavorable because there is a risk for earnings downgrades. So let's talk about the Goldman Sachs note first. Constructive on the sector going into this year, and this is because the earnings growth will accelerate. Now, they're penciling in a 7% top line growth, which is a pickup compared to 4% in FY25 and a 1.5% growth in FY24. Now, this recovery in growth is driven by US being strong. That's 60% of your revenues. BFSI, consumer, tech, these are strong verticals. Positive commentary from US banks, which are basically clients of IT companies. Accenture's numbers we've spoken about, the guidance upgrade. And even, when Goldman Sachs conducted an IT spending survey, the CIO seemed to indicate that the spending environment is turning far more benign. That said, they do expect some revenue pressures in the near term, revenue or margin pressures, and this will be company specific. So particularly for TCS, for instance, which is the first one to report the numbers, Q3 earnings, there could be headwinds because of the ramp down of the BSNL deal. Or for LTI Mindtree, there could be wage hike pass-through impact. But according to Goldman Sachs, all the weakness on account of these company-specific factors should be in the numbers once Q3 is done. But they are also cognizant that valuations are on the higher side and Europe is an area of concern. But Investec, on the other hand, is not so constructive on the sector. Risk-reward is unfavorable. They see a potential for marginal results downgrades. IT stocks are trading at a premium to Nifty, despite it having lower growth compared to the Nifty stock. The deal wins have weakened. So on the whole, they don't seem to like it very much, but they prefer Zensar and KPIT Tech in the IT pack.
Well, thank you so much, Rima, for taking us through what one can look forward to as far as the Q3 results season are concerned. Well, a couple of stocks on the radar. Sony just spoke to us about IEX, that particular stock trending near the day's highest point. Manappuram Finance, especially in the last half hour, has built on to its gains. And Muthoot Finance, the other gold financier too, is now trading near the day's highest point. But moving on, JSW Neo, a wholly owned subsidiary of JSW Energy, last week signed a definitive agreement with O2 Power to acquire 4,696 megawatt of an RE platform. We spoke to Sharat Mahindra, Joint Managing Director and CEO. But before that, let's have a look at what exactly brokerages have made of this particular development. Axis Capital, they're quite positive as far as this particular development is concerned. They've maintained their ad rating. What they're saying is that the equity upside for this particular deal works out to close to 35 rupees a share. Investec values that this particular deal could lead to an upside of close to 45 rupees a share, while Motilal Oswal believes this particular deal could add close to 57 rupees a share if the acquisition as well as the operational capacity comes on stream, as the company has indicated. So overall, a thumbs up from brokerages. We also spoke to the MD and CEO, like I alluded to earlier. Let's listen in to that conversation.
That we are getting a very, very high quality asset, and which is close a total at a built up to 4.7 gigawatt of capacity, out of which by June 25 almost 2.3 gigawatt will be operational. And as we are aware of wind build of around 8 to 8.5 crores per megawatt, and then we see that what is that turns to for 4.7 gigawatt. We have found this very, very attractive. The H1 was exceptional in terms of two factors. One, the elections, which stalled the investment which was going on, especially from the government side and also the private investment. And we saw government spend a decline, marginal decline, as if we compare with H1 of last fiscal. So, but yes, and then the extended monsoons which were there. These were the two factors. But we have seen in last 1 month, especially last 2 to 3 weeks, the demand as well as the tariffs have started going up significantly, what we have seen in Q2. And we are absolutely certain that demand pickup is there. And the tariffs also are moving upward. And that is purely the demand supply scenario. And once the demand is picking up, the tariffs also, we are quite certain that will be inching upward only. I am happy to inform that we have just 2 days back, we have received the consent to operate letter. And we have just, the unit has been lit up, and maybe it's a matter of few days that the synchronization of the unit will also happen and the COD. I'm happy to announce that as we have been maintaining that we'll be close to 10 gigawatt with our greenfield projects which are getting commissioned by year end. We are on track of that. And over and above this, with this O2 acquisition and operational capacity current, and by June 25 reaching 2.3 gigawatt, and once the KSK process happens, I'm happy to tell that by June 25, we will be definitely exceeding significantly the 10 gigawatt number. Barmer, our plant is running full. In terms of expansions, the government of Rajasthan has to come out with the requirements. They are contemplating, because Rajasthan is one of the states where the power demand is growing more than what the national average is. And the power demand projections which the state has done, because recently the Rising Rajasthan Summit, also when the discussions happened, that the demand, the way Rajasthan is growing and focusing on make in Rajasthan and with industrial policy, which has favorable industrial policy, which has come up, I think the demand growth is going to be significant.
That's JSW Energy, one of the big winners of the day. We will slip into a very short break, but with the news that now the action is picking up even in the mid-cap index. The mid-cap index is up 250 points. That's a near 0.5% rally. Pharma is one of the big, sectoral winners of the day. We spoke about the recovery in banks, and that seems to be continuing. The advanced decline ratio, though, is still in favor of the losing side. ITI is now popping up in terms of the gainers list. Manappuram Finance is a 4.5% move. Campus Activewear 4% higher. Sagility has been strong since morning, and it's a 50% gain for Sagility. Issue price, remember, for Sagility was close to about 30 rupees. RK Developers, Bajaj Housing Finance has made quite the comeback. PNB, Yes Bank, Zomato. Lots of winners in the broader markets. Get into a break. More on markets and fundamentals with Sunny Agarwal of SBI Securities. Welcome back. Let's talk about the way forward. What should be the top picks going into 2025? Sunny Agarwal from SBI Securities is now with us to discuss the market fundamentals and his top ideas. Sunny, thank you very much for joining in. I was just going through some of your, big bets. So you've got hotels, chalet, parks, Samhi, alcoholic beverages. You like a few railway wagons, capital marketplace. But in all of them, I don't see too many news listings, listings of 2024. There is an odd the park thrown in. But generally, you've stayed away, and we've got some blockbuster listings. The IPO debuts have been very strong. So didn't any of them catch your attention? For instance, today you've got one in the pharma space, Senores Pharma.
Yeah, thanks, Rima and Vivek, for having me on the show. I think among the new listings, there are a few interesting businesses which are getting listed. A case in point, a very tepid listing for Ventive, which is a predominantly very large portfolio of hotels based out of Pune. There again, we feel that post-IPO over the period of next 3 to 4 quarters, I think it will be a kind of turnaround performance. Looking at the way other hotel companies are performing across the board, improvement in operating metrics. So I think even Ventive post-IPO, we believe that although the company has reported losses during the first half of FY25 as per the reported number, but we believe over the period of next 2-3 years, the company will report a very good set of number, and Ventive is one of the companies which I would like to track and add over the period of next 3 to 6 months among the new.
Sunny, so from the newer listings, you like Ventive, but one particular stock you have in the auto ancillary space is actually Lumax Autotech. Why do you like that particular name, and any other names from the auto ancillary space you like?
Yeah, Vivek, so we have initiated coverage on Lumax last week, and we believe the portfolio of the company is basically powertrain agnostic. So if you look at the product, basically head and tail lamp, plastic tanks, door panels, switches, sensor, two-wheeler frame, seating structure. So most of the portfolio for Lumax Autotech is a kind of powertrain agnostic. At the same time, they have recently acquired 2 companies. One is IAC India, that was in Feb 23. So that has given a lot of exposure on 4-wheeler side. So earlier the portfolio was skewed to a 2-wheeler side. So 4-wheeler, again within 4-wheeler, Mahindra and Mahindra is one of their key client where kind of more than 30% revenue comes from Mahindra and Mahindra. That continue to remain an outlier for that company. Again, one recent acquisition, Green Fuel, again that gives an exposure to the alternate fuel business. Basically, they are into the CNG and hydrogen vehicle component overall. So what I feel is that being an powertrain agnostic company, we are penciling sales, EBITDA and PAT growth of 28% and 28% and kind of 50% over FY24-26 period. And we are expecting the company to report PAT of close to 295 crore in FY26. And at a very conservative valuation of 20 times September 25 EPS, we have arrived at a price target of 857. That gives a close to upside of 30-35% from the current market price.
This Protean eGov, while it's come off about 11% from its recent highs of 2200, it's still up 65% so far this year. And I remember one of the market veterans talking about the entire digitization theme and how Protean eGov could be an attractive stock. Now, after this kind of a run-up, what will drive upside from here on over the next 2 years? And is the current level of 2,000 an attractive entry point, according to you?
Yes, we believe that the fair value of the business for Protean is close to 2,400, 2,500 rupees. And one of the key, basically, it's a traditional legacy business of PAN, Aadhaar, and all those stuff. We believe that will grow at kind of 10 to 12%. And on the other hand, the new businesses such as the data stack, agri stack, and all those businesses that will drive the basically on tax advisory side. So that will be one of the key growth driver for the Protean. And we believe that earning will grow north of 20% CAGR over the period of next 2 years. And the fair value is close to 2,400. Obviously, post run-up, the return from a current levels looks like kind of 20% CAGR over the period of next 2 years.
Sunny, a couple of stocks, we want a quick use on that. First up, from the construction equipment space, you have a positive view on Action Construction. The stock is up almost 5% today. So your view on that. And also you like defense and aerospace, but largely through much smaller players. So you like names like Zentech, Dynamatic Tech, and good luck, your views on these spaces.
Coming to basically construction equipment, we believe that the implementation of TREM 5 regulation from 1st of Jan that will lead to the pre-buying in the December quarter. The reason being that post-implementation of TREM 5 regulation, we may see a price hike of close to 10 to 12% by all the construction equipment player. And ACE being a market leader in pick and carry as well as tower crane, where more than 60% stake is market share is held by ACE. I believe the ACE will be one of the key beneficiary of that. And December quarter is the quarter where we are expecting a very blockbuster, a very good set of number from ACE. And our fair value of the company is close to 1,800 rupees. Coming to defense, Zen Technologies under our coverage, and we believe that during the full year FY25, the order inflow will be close to 1,200 to 1,500 crore rupees. So order book was close to 950 crore in the first half FY25. We expect the order inflow to pick up from second half. And for full year, we are expecting company to clock revenue of close to 900 crore. And we expect that number to scale up to close to 1,300 crore in FY26. And the company has got an internal target of 2,000 crore in FY27. So again, a very company which is growing at a rapid clip. Again, PAT of close to 338 crore. That is our number for FY26. ROE, ROC of more than 25%. However, the stock has run up recently. Then what we believe that buy only is the right strategy for Zen Technology with a price target of 2,500 and investment horizon of 12 months.
Sunny, I'm going to put you on the spot, asking you to pick one stock for 2025. If you had to do that, which one would it be?
Again, if I have to pick one stock, again, I would like to go ahead with a Chalet Hotel for 2025. The reason being that the company is expanding its hospitality keys by close to 28%, and office portfolio will contribute close to 10% of top line by 37% over the period of 2 3 years. The recently company has mobilized 1,000 crore through QIP, and that will deleverage its balance sheet. At the same time, we are expecting ROE, ROC to expand from ROC from 9.5% in FY24 to 16% in FY26. So we believe that the profit of the company will double over the period of next 2 years from close to 280 crore to 500 crore in FY26. So Chalet Hotel is the one stock which I would like to add with a price target of 1,100 for FY26.
Thank you so much for joining us, Sunny, and giving us all of your picks and your views on individual stocks as well. Well, let's now slip into a short break. Up next, we dive into the India capex story and how it played out in 2024. Stay tuned.
Welcome back. The Nifty Bank recovery continues, and even for the Nifty now, it's a good, it's a good 90-point up move, and the Nifty has now crossed that hurdle of the 200-day moving average of 23,860, and it's courtesy the recovery in large banks. The Nifty Banking Index is now powered to a 1% rally, more than that, 600-point gain. Shriram Finance is up 2.2%, IndusInd Bank 2%, Axis 1.6%, Kotak Mahindra 1%, ICICI, HDFC Bank 2%. pushing the indices higher with the kind of up move. This is a big, big move. Again, remember, it's coming in on thin volume, so it's easier to push up stocks and not push up, but it's easier to move, on either side, up and down, when the volumes are on the thinner side. But today, the bulls are trying to gain control, and now things are looking up. The Nifty's crossed the 200-day moving average, a positive sign for technical analysts, and it's closer to 23,900. But we're winding down 2024, and India's capex story has been changing the game. India's growth story has been getting a major boost from a massive capex push. Mamakshi breaks down the year that was for India's infrastructure boom.
India is upgrading from approximately 3 lakh crore in FY17 to a record 11 lakh crore in FY25. Capital spending has more than tripled. From the roads we drive on to the railways that connect our cities, from the factories powering our industries to the digital networks bridging our lives, the capex story is reshaping the nation. This surge in investments comes after a decade of decline from 2011 to 2021. Gross capital formation as a percentage of GDP has rebounded from 28% in FY21 to 34% in FY24, with Morgan Stanley projecting it to reach nearly 36% by FY27. What makes this cycle different is how diversified it is. Unlike the 2003 to 2008 boom, where investments were focused on just a handful of core sectors, today's capex is spread across 23 to 24 segments, creating a broader and more sustainable foundation for growth. Despite this progress, 2024 has been a chink in the armor. By October, the central government had achieved just 42% of its ambitious 11 lakh crore capex target, the lowest in recent years. A big reason for the slowdown was the general election-related restrictions. On the state government capex side, rising welfare spending is becoming a challenge. With the enforcement of the 3% fiscal deficit limit likely to get even stricter, the rise in revenue spending leaves less room for capital investments. This means the heavy lifting will largely fall on the shoulders of the central government. Capex has been slow so far, and hitting the ambitious annual target will need a sharp 60.5% year-on-year growth. As per MK Research, the central government seems on track to meet its target, but the states might fall short by about 0.5% of GDP. Combined, the centre and state capex is expected to come in at 4.9% for FY25, a bit below the budgeted 5.4%. Nevertheless, as we step into 2025, the sluggish momentum seen is expected to now reverse. Another sign of this activity picking up is the sharp drop in the government cash surplus balance from 2.67 lakh crore in the first half of FY25 to just 28,300 crore by the end of November 2024. Since revenue spending is usually steady, this big dip likely points to a ramp-up in large, lumpy capex projects. Private capex has been another crucial piece of this puzzle. Data from MK Research indicates that after bottoming out at 2.2% of GDP in FY22, it has now started to recover, reaching 2.9% in FY24. Cleaner corporate balance sheets with a leverage at over a decadal low, along with government initiatives like PLI schemes, robust order book in capital goods sector hint towards an upturn in private capex as well. So will 2025 truly be the year of capex? For now, the groundwork has been laid and 2025 holds immense promise. It's too early to say, but with the central government taking the lead and private capex showing green shoots, all eyes are on how the story unfolds.
Well, very interesting piece there by Vamakshi. But with that, it's a wrap on Trading Hour. Stay tuned. Halftime Report is up next.